His question is, he's applying for a summer analyst position in IBD. Wanted to know if there were any questions asked about valuation methodologies used, or in parentheses, DCF, trading comps, transaction comps. And if that's the case, then what would the interviewer expect my level of knowledge to be with regards to those methods? And if not, what would typical questions be asked during an interview? Okay, so kind of addressed some of this briefly in some of the earlier slides. But yes, to reiterate, there will definitely be questions asked about these valuation methodologies, DCF, trading comps, transaction comps. And so again, kind of talked a little bit about the DCF and what you're expected to know there. I'll spend a couple minutes now talking about what to be expecting for trading comps, transaction comps, and things like that, because those are pretty important as well. So as I mentioned before, a DCF is an intrinsic valuation. Trading comps and transaction comps are really more relative valuations, right? And hopefully you guys understand the difference between those two concepts. So I won't spend too much time on that. But for trading comps, you can be asked pretty basic questions like, okay, so if all your companies in a peer universe trade at 8 times, and here's my company's EBITDA, what would their firm value or what would their enterprise value be, right? So that's kind of as basic as the questions can get. Transaction comps, so you should be able to understand things like premiums paid, right? So when you're dealing with trading comps, those are just kind of the valuations that firms trade at before they're acquired, right? So without any M&A speculation, your firm trades at 8 times enterprise value to EBITDA, right? When people are thinking about acquiring this firm, they understand that they're going to have to pay a premium, right? So they're going to have to pay a control premium to control the company, and they're going to have to pay a synergies premium, right? Especially if it's a strategic buyer, they pay a synergies premium because they're going to get X number of synergies out of this deal, right? And so for transaction comps, you should kind of know where premiums might sit in today's environment, right? Today, maybe premiums are 25 to 40% on top of equity values, right? And you should understand kind of how those transaction comps work, which transaction comps make good transaction comps, right? So if you're, let's say, if you're a standard industrials company, right, your valuation now is going to be very, very different than your valuation back in, late 2008, 2009, when the market had just crashed, right? So ideally, you're looking at companies with similar growth prospects, risk profiles, companies of similar sizes, and also transactions that have occurred in similar economic environments, right? And so, as I mentioned, a company now in the industrial sector would trade at a very different multiple than the company back in 2009 when the economy was very depressed, right? So you should have a pretty good understanding of what makes a good transaction comp, what makes a good trading comp. And for trading comps, it's a little bit easier. It's just kind of the first 3 things that I mentioned for transaction comps or precedents. And those are just growth prospects, risk profile, and size. And obviously, there are a lot of other things, like ideally they're in the same industry and they've got similar business models and they deal with similar distribution channels and end customers and things like that. But what it kind of boils down to is growth prospects, risk profiles, and size. So if you can hit those 3 things, then you've won half the battle already. So those are some questions asked about the DCF trading comps and transaction comps, also known as. If you have the time, LBOs are a great thing to know. It's a little more advanced, and so your interviewers may or may not dive into that, but very often they will. And so having a good understanding of what an LBO is, right? So it's just kind of a highly leveraged acquisition where your buyer is taking on a lot of debt to fund the acquisition, and then A, growing the business, and B, paying down debt over the course of time to then sell the company at a big profit, right? And so that's kind of what it is at a very high level. The nuances of modeling it and understanding all the details of how an LBO works I won't get into right now, but if you have the time, those are questions that are fair game, and people can expect you to know those things.